Hello and welcome to the September edition of RCLCO's monthly economic update. My name is Scott Bommarito, and I'll be covering a couple of the economic highlights that we've seen over the last month. To begin, an unfortunate headline that we've all seen at this point, that the CPI inflation accelerated again to 3.7% in August, which is the second consecutive month of an increase in the annual headline figure. Most of this was due to rising gas prices. Gas prices increased 5.9% month over month in August alone, and that buoyed the all items index by 0.4% in August. On the other side, core inflation continued slowing in August, a slightly more positive development, and it fell down to 4.3%. Which is obviously still elevated, but below that all items figure. The chart on the left shows the month over month increase rates, and it shows that over 2023, both core and all items prices have been slowing, which is a positive development. Over the last 3 months, the headline prices are up 3.9% on an annualized basis, while core prices are up 2.6% on an annualized basis. So still slightly above target, but improving. Overall, the expectation is that this moderate easing of inflationary pressures continues, with target inflation of 2% being reached by probably early 2025. So diving into some of the components of inflation, as I mentioned, gas prices were the primary driver of August month-over-month inflation. But over the last year, energy prices broadly are still down 3.6%, despite the month-over-month pop in August. So annual inflation really still being driven almost exclusively by services, which were up 5.9% over the last 12 months. And that's what's feeding core and headline inflation. Now, there are two big inflationary threats in the near to medium term. The first being oil prices. Saudi Arabia and Russia have restricted their oil supply over the last month, and that's likely to continue in the near term at least. The second inflationary threat would be consumer and investor expectations around future inflation. The University of Michigan Consumer Sentiment Survey has been showing a decrease in inflationary expectations for several months now, although the August reading did tick up again to 3.5%. So if we have a couple more months of a hotter than expected CPI report, it remains to be seen what that will do to expectations. And the risk does remain that that kicks off an expectation cycle of higher prices. On the other side, moderating some of those downside risks, the employment reports have continued to cool and show a labor market that is definitively entering a period of moderation, which is good news, at least from an inflationary perspective. Unemployment and labor force participation rates both increased in August. Unemployment rose to 3.8%, so finally coming up off of that 50-year low where it had been hovering for the past several months. The labor force participation rate increased to 62.8%, although it does remain slightly below its pre-pandemic rate. This is just the overall labor force participation rate. On the prime age 25 to 54 population, the employment rate among that group is actually higher than it was pre-pandemic and has been for several months. Job openings have also decreased. The latest job opening survey, which was released in July, showed 8.8 million job openings, which was down from a high of 12 million in March 2022. The corresponding number of unemployed workers was 5.8 million in July, which has since risen to 6.4 million in August. So as job openings come down and as unemployment starts to slowly tick up, that ratio of openings per unemployed worker has compressed and is now down to 1.5, which is down from its historic high of 2.0 in March, but still obviously indicates a fairly tight labor market, as employers have proved unwilling to lay off large numbers of workers. So turning finally to interest rates, the big news, of course, is that the Federal Reserve is meeting today to decide its path for the federal funds rate for the month of September. Expectations are that it will hold rates steady, but that it will keep open the option of a hawkish pivot in the event of hotter than expected inflation or employment reports in the coming months. Those high rates, of course, have been trickling down into the US Treasury yield curve, which remained highly inverted in August despite increasing long-term yields. The chart on the left here shows the yield curve at the end of August relative to August of last year, and shows that rates across the curve have increased pretty dramatically. And in fact, rates have even increased from the end of 2022. The chart on the right then shows 3-month, 2-year, and 10-year yields. I'm just, again, driving home the inverted nature of the yield curve over the last 6 months, and really before that as well. The 10-year US Treasury yield rose to 4.34% in late August, which is the highest rate it's been at since November of 2007. Yields ended the month slightly lower, but since then have ticked up above that 4.3% as of mid-September again. That concludes our September macroeconomic update. Tune in again in October for more economic news and for our full webinar.